Over to you, Ralph.
Oh, right. Good morning, everyone, and welcome to this program on issues for a mature company and at all times. I mean, the original remit was about mature companies, but topics concerned cover all companies. But first of all, let me introduce myself. The very first thing is, if you happen to look at my picture, which I would advise you not to, I may look with a closed left eye or look as if I'm winking, which I'm certainly not. I'm just telling this tale not looking for sympathy, but as an interesting warning. I had a detached retina operated on now 5 weeks ago, and I'm getting better. Excellent service from the NHS. It all started when I woke up almost unable to see out of my left eye. And I thought, well, this is strange. Didn't think of rushing to do anything, but did go to good old Specsavers it was. They're not supporting this advertising, but it was Specsavers. Asked if they could check the eye, and they did. Excellent optician, and said, get to hospital straight away. It was the detached retina. And, I'm aware if you have chest pains and other things, to get to hospitals. This didn't occur to me, but again, since I've had this and talking to friends, it's not an uncommon occurrence. And yes, you do need to get it fixed as soon as possible. Otherwise, you may lose sight in the eye. So I'm winking just now deliberately, like, Dick Deadeye, the pirate. My daughter said, actually, I should have a parrot on my shoulder to warn people, but it's just that's it. And also, it may affect my reading slides if I am slightly slow. It's just my sight isn't perfect. So there we are. There's the sob story to start with. A bit more about myself. I am a chartered accountant, but started out as an engineer in the power industry, and I have to say, commissioning power stations, coal, of course, boo, oil, gas, but mainly coal power stations, all closed down and shut down by now. But I started out with that. I knew nothing about money. I think in my 4-year degree, we did a third of a year on accounting, because it was realized all those years ago that engineers don't think enough about money. But I realized I didn't know enough about business and money. If it was today, I'd have probably gone for an MBA, but there weren't the MBAs around then like as today. And I knew you could train as an accountant. And I thought, well, 3 years out of my life, but, worth it. And so I fortunately, I applied. You realize from the accent, I hail from north of the border, but I was working in London. I applied to Coopers and Lybrand. We're brothers, in fact. They just changed Coopers and Lybrand. And they very kindly, if you like, took me on. It was February of a year. They said, we'll take you on, join in September. At that time, I was 24, going on 25. They said, we'll take you on, but you're getting old. So over the hill as I was, I trained in London, got through my exams with Cooper 6 years, got into speaking with them, and returned north to the Scottish Institute to lecture there on accounting and auditing. But after a year, set up my own practice, and I've been in practice ever since. My work has always been on the audit side, and I'm retiring from that now. It was a pleasant profession, an interesting profession, and still can be. But that's my background, and I hope that with the background and clients I see today, I think particularly important bringing it right up to date. It's seeing what problems businesses have, mature businesses, good businesses, ones that might be struggling. So that's quite enough on me. The program, let me go on one slide, if it will kindly. The program, what is capital? In putting this program together, we had the idea it was about mature company and working capital particularly, but there's a lot more to it. So what I've done and put together as a program, what is capital? This is just maybe out of interest, I hope. The word capital is used in business in so many different ways. So it's probably stuff that you all know, but it may be there may be something that's worth knowing. What sort of capital do we have? What does capital mean? Then there is a session on working capital management. And the thing I want to mention was that I know people have lives and want to skip off for something or maybe make a call. And I am aware that people might not sit through 3 hours nonstop. I admire you if you do. But just to give you some idea of where we'll be in the morning, I thought that might help you. I intend to talk on capital up until just checking the time now, maybe for 10 minutes. The working capital management then to after 9:30, and then cash management forecast to the first break that we will have. We will have a break, and let me consult my script, at about 10 o'clock. So we'll have a break then for 15 minutes, no longer, on the cash management forecasting. Then this whole question of maturity, but where we are, I wanted to talk about purpose, why you're in business at maturity and start, etc. So that is going to take a good half hour, take us up to 10:30, 11:15. Purpose includes looking at return on capital employed. I mean, I know topic that is ignored these days, but it's a good central topic to talk around the value of a business and what a return is. We have return on equity, we have return on capital, whatever that means, of course, loose word. We have return on capital employed, a traditional textbook measure. So that will take us up till 10:35, 10:40. Then I was going to look at 3 topics which are always topical: budgeting, cost reduction, and cost awareness, which maybe is almost more important than cost reduction. Just, are you and your people aware of costs? There are articles out now on, where are we going in the economy? Who knows? But purpose includes quite a lot of interesting areas, and slides on the topics to prompt me, but I hope to usefully give ideas of what you might do to improve business, if you like. Then up to 11 and after 11, capital budgeting, capital investment appraisal. My favorite topic, but I can't have hours of it, maybe not appropriate for the majority, because capital budgeting is about the large capital spend projects. And, with the new government, apparently there's a lot going on. A major capital spend project is HS2. So at that level, that's project appraisal. I mean, I've been involved in rail ones. I'm sadly, another interest is that I have quite involvement in the rail industry. But capital budgeting is important. And in the few slides I've got, I just want to make the point that sensitivity analysis can be very clearly demonstrated in models. They are simple models. And it's something that, from an auditor's perspective, from a board's perspective, and anyone involved in preparing accounts, we are asked to do more sensitivity analysis. And indeed, it can be very helpful. And then I've got a final slide, prioritize your issues. I have some additional material added, and far too much, and some references dated, actually. I was going to slim this down entirely. I'll probably just talk to 2 or 3 slides. But as an auditor, this question of maturity, what I find is with very decent, good private companies, there is not the formality in governance there should be. And I thoroughly empathize with these companies. They're running good business, they're doing it right, they're not rogues and scoundrels, which our regulators seem to think we all might be, they've got, they don't have the time, or they don't see the importance of governance. So just a couple of points there, actually, and that'll take us up to 11:45 or so. Regarding questions, I will have a look at the breaks and try and answer questions and maybe go through them after the event. Also, you're welcome to email me and get in touch. You can find me on the web. But just if there was something I said you want to pick up on, then please do. But I will try and answer the questions that these are posted during the event. So that is what we aim to do. And let us move on. Right. Capital, what are we talking about? And I think the first comments, bullet points are from Investopedia. And when I say I think, I'm sure they are. I just want to make the point that capital of a business is the money it is available to pay for its operation, etc. Four major types of capital: capital, debt, equity, trading capital is used by brokers and other financial institutions. Fine. The capital structure is very important. And that's where private equity make their squillions, is by getting a suitable capital structure. It's how the water companies' owners made lots of money, structure, the right structure. And then economists look at the capital of a family, a business, or entire economy and evaluate how efficiently it's using its resources. What I'm saying there is lots of definitions, and I said this at the outset. And I always like to look at dictionary definitions, and the favorite is the American Merriam-Webster dictionary. They talk of capital as a noun, a stock of accumulated goods, especially a specified time in contrast to income received during a period. Accumulated goods devoted to production of other goods, accumulated possessions calculated to bring in an income. So capital, investment, these words get mixed up. There is vagueness. And what I'm saying is you need to be very clear when people start talking about capital, what do they mean? It might not be what you expect. So again, moving on, and I'm just moving my wretched screen with my picture. I don't want to see me. It's out of the way, thank you. And move on. Types of capital. Common uses of capital in business, common uses of the word. Working capital, and a topic we're going to look at separately. I think everyone's well aware of this. Stock, inventory. I mean, I use both the UK and US, and the US terms are becoming more prevalent. But stock, inventory, debtors, bank balances. So current assets, less current minus, a small minus there, current liabilities, payables, accrual, short-term liabilities. The working capital of a business. It's not just theory, the arithmetic dictates that ideally it should be as low as possible. That is the net working capital, i.e. current assets, current liabilities. What am I saying? You shouldn't have money in the bank because it's idle. You shouldn't have stocks because they're idle. You shouldn't have debtors because they're idle, so zilch. And in fact, what I'm now going to say is you should have working capital as high as negatively high as possible. You should owe your suppliers, but not cheat them. You should owe banks, but pay when you have to, have overdrafts. You should be living off other people's money. Now, that's the arithmetical theory. Back to simple, as low a figure as working capital as possible. But the problem is, of course, you need stock. You have to offer sales on credit terms, and stock sits there and debtors don't pay. You maybe have higher current assets than you'd wish. Liabilities tend not to go away, so that you're stuck with them. More on working capital later, and I'm sure you do all this stuff thing. So working capital, though, is absolutely vital, whether you're a startup or a mature company. Maybe in a mature company, you get soft about it. And I mean, an example of demonstrating that is, why are companies taken over by, I don't say private equity, but taken over? And the answer is they've got flabby soft, and one area will be working capital. And the new owners come in and say, get rid of half of the stock, chase your debtors, etc. So we see it in real life. Another next use of capital investment in fixed or non-current assets. The modern term is non-current assets as opposed to current assets, working capital, net current assets. But capital investment is in your building, your machinery, your equipment, whatever else. So capital investment, and that's what, for capital intensive, we'll come to this word, businesses, that is what you should appraise. You should be careful about what you carry there as capital. Right, on the topic of capital expenditure, words that are linked, they all use capital in them. Capital expenditure, CapEx, is when you're planning, you're planning to spend money on equipment. To capitalize something is where you repair. An example would be you repair a machine, but actually it's not a repair. You've rebuilt it and you've actually put on computerized control and you've changed the motor to a switched reluctance motor. Aren't these wonderful terms I love? Switched reluctance motor. They have them on the Jubilee Line trains. That's why they make the noise they do. Anyway, that's by the way. You capitalize a repair where you effectively add 10 years life to the machine and it performs more. Then you could capitalize some of that expenditure. This maybe demonstrates to you capitalizing has to be looked at very carefully by an auditor, but also by the company doing it. It's the company and the board of directors who decide to capitalize something. As an auditor, I have to say, well, is it really got value? Can you demonstrate you're getting more output using less energy? What is the value? It is a difficult area, often can be a very difficult area. A company that's undercapitalized is interesting, is that they in a sense are living with, I'll use very simple examples, they're living with one machine, which of course breaks down and whatever else, and their performance is poor because they haven't got the investment they need. It might not just be machines, it might be they have too low levels of stock. That happens. You're out of stock and you can't sell and you lose business. Your reputation goes and everything else. So you can be undercapitalized. Most people bore on about overcapitalized, too much capital expenditure, etc. You can be undercapitalized, something to think about. Overcapitalized is where you may have too much. Idle capital happens where you have, and again, idle mostly in the sense of either stocks that never move, but you feel you should carry them, or you have machines that don't work. And I've got clients in that situation, but what do? You carry them at the value that they were bought at if they are not impaired. This is a very important word, i.e., if they're never likely to be used again, you really could be writing them down or writing them off. But idle capital can sit there if there is a clear expectation it will come back to life, if you like. Capital reduction is actually nothing to do with your capital employed in the business. Capital reduction is you have share capital of 1 million and you reorganize the shares to have 10,000. Shareholders will have to agree. There has to be obviously a good logical reason for doing this. So some other uses of capital, and as I say, the danger is to bore on too much about this. Capital structure, again, is very important, very much to the city, to investors. Share capital or equity, risk capital, another term for that. Is it a risk? And types of risk capital. Loan capital. Retained capital equals retained profits or reserves. So you actually have shareholders' capital in the sense of the retained profits or reserves, which they keep back. In other words, they make profits of 1 million, they keep back 900,000 because the 900,000 is hopefully there as cash briefly, and the cash has been spent to buy new equipment or add to stock. So capital structure, very important. And the whole banking finance industry is very much focused on the capital structure area. Capital employed, and we'll come to these ratios later. Return on capital employed is return on capital employed, ROCE. Return on investment, ROI, more common use. That tends to be an American term, but it's more commonly used. And then we have return on equity. And both ROCE and ROI are the same. And return on equity is different because the profit you make is only on shareholders' funds, which is the capital and retained profit, whereas return on capital employed is the return on all the capital. They are both important. I mean, one not more than the other. I often think that, I see people talk glibly, oh, return on equity, return on equity, return on equity. And I can understand because that's the finance people talking, the bankers, the investors talking, and it is very important. But quite often they miss the point that long term, if you don't make a return on all the capital, then, and we'll see this later, then you're not going to have a good return on equity. To me, return on capital employed is a precursor to making a good return on equity. So again, in this introductory session, I'm just trying to make the point that capital is used all over the place. We need to use it carefully. We need to understand what it means. I'm sure you do. So moving on quite quickly to, or maybe not quick enough for some of you, on to the question of working capital issues. Working capital issues, current assets, current liabilities. And this is a bit of repetition here. What are current assets? Stock, inventory, debtors, receivables, and bank, not ANK balances, bank balances. What are current liabilities? Payables, and I didn't use these terms earlier. Payables, the American term, creditors, the British term, which is not there, accruals, and short-term liabilities. So a bank loan due to be paid in the next 12 months would come under current liabilities. Bank loans over 12 months come as long-term creditors or liabilities. And working capital issues, again, just making the point, capital investment is different. It's in fixed non-current assets. Right, working capital issues. Here's a table for you. Hardly earth-shattering, but if you have working capital issues or you're concerned that you might, here's a list of, not exhaustive, but the common terms. Stocks, problem, too high. Solution, destock. Change your supply chain, outsource. And the supply chain is something you endlessly hear about, but it's very important. And I have to say that, an example would be a local garage, or even, a chain of local garages. Years ago, they would carry spare parts for all things coming in, because if they ordered wheels, they ordered drives or anything else from suppliers, it would take over a week, maybe a month. So the local garage would carry stocks. The manufacturer, or possibly there's also a distributor in the chain, would carry stocks so they could supply the local garage in a week. The manufacturer would carry stocks and they would supply stocks monthly. So you get everyone holding stock down the line. The supply chain is something we hear about, we all know about, and the answer is to have the manufacturer make to demand and supply directly to the garage the next day via high-speed delivery people. So if you like, what it's done is taken out the intermediaries in quite a lot of cases. But I'm sure more can be done on that. The danger is that you're out of stock and business seizes up, or business, really seizes up. The person who's got the stock gets the business. So the whole stock cycle, very important. The outsource is to, something where you need stock, you get someone else in to have the stock. I mean, example, there would be department stores. They've virtually disappeared. Talk of them coming back, maybe. But I mean, the department stores didn't carry all the stocks of the perfume and all stuff when you went in. That was by the seller. So you're actually outsourcing part of your business. All this stuff always worth thinking about, a mature business or any business. Work in progress too high. Review the production process. I put that on, and that's thinking about work in progress within a manufacturing business. In other words, a classic would be for a printer that you have paper, which are really raw material stocks. You have inks, raw material stocks. You have stuff that has been printed once with the magenta, and it's going to get through printed again with different color. Your stages, and the answer is to get the production process, and with modern equipment, hopefully, stuff is just printed in and out. And going back to your stocks, you get paper in one day and it's out the door as a brochure or something to your customer the next day. So the production process is maybe the key area to look at there. Contract WIP too high. So, and we don't actually tend to talk of contract WIP these days. I do. I mean, work in progress is, to me, very much a thing. The construction company has work in progress, but it's seen as unbilled work is the term, which it is. It's another term for it. It's talked more of as unbilled work and other terms. But work in progress where the customer has no reason to pay you, has not paid you. If you let your work in progress on site go up, and if you're dilatory on site and things are done slowly within your time frame, you get good examples. You get hired equipment to site ready to work a week early. That's a cost. You've got steel structures delivered to site to be installed next week when you don't need to. It's just your laziness, as it were. Then you've got high work in progress. No one is paying for it for a few weeks, if not months. You have a problem. And obvious answer, better project management. What I haven't put on there, and I should have done, is better, obviously, contract terms. The ideal is that you get your customer to make progress payments if it's a long enough, big enough project, and those payments equal, and if you're very smart, better what you're paying out at the time. But in other words, you're getting the asset which is sitting there doing little, the work in progress on site. You get it funded by your customer. So that is equally important. I mean, it's part of better project management, better procurement. And construction contracts, I'm picking it up there because I wanted to use the other term. Construction contract advance payments would be a solution. Debtors and receivables in working capital assets, current asset. Chase, sell for cash, factor. Factoring's still around. If there's any of you in the factoring business, forgive me, but I've never seen factoring as really an answer. It often, why factoring is good, there I'll get a plug for factoring people, is that it brings discipline often to your chaos. But a reason for poor debt collection, having to chase, is simply poor debt collection processes, being very clear when you should be paid, following up and chasing. And a lot of companies get into position. I was just talking to a client on not an audit, but some other work, and change in accounting systems. They've got debt collection issues. Apparently, it happens. It can happen on an acquisition because you take over a company and their procedures are different. And it is a problem that you need to solve yourself. And that's my point about factoring. One way of releasing funds, and a very proper way of releasing funds, but often why it helps, if it does, is that it brings discipline to a chaotic situation. Prepayments too high, change terms. This is where what I'm suggesting is if you can pay monthly for your insurance, fine, but often you get a better deal, or you can only get a contract for a year, so you can't change that. Current assets being idle, bank too high and idle, simply invest, put the money somewhere else. But I mean, I've got clients, I mean, they sit, and the smaller business, maybe the mature business, using the title term, the mature businesses often, they don't get lazy, they're just happy to sit in a million. I'd be happy to sit in a million if I was doing other things and everything was fine. So the answer to what you should do there, I think, is quite obvious. Right. Current liabilities, less of them, the problems and the solutions. Creditors, payables too high, you owe too much. Cheaper suppliers, is there overstocking or delay? So why do you have the high liabilities? As I said, actually, of course, having high liabilities is important if it's when you're not paying people. But if you have them because you just are overstocking, if you've got poor payment terms, then negotiate. You're paying your supplier, and they're very happy because their assets there. It's with them, not you. And solution is the bank balance. Do you have too much in the bank? We'll pay off the payables. So, I mean, I think those are probably obvious areas. And accruals too high. As for creditors, don't pay for stuff before you have to, but do pay for it within the terms of the business. Accruals, I could refer back to contracts again. Quite often, problem with contracts is you have to accrue for remedial work, etc. That is a case of negotiation. That would be a case of negotiating better terms. So that is working capital, and let me just check what I have now. Ties in. There are so many topics you could tie in. With working capital, we could look at and set up a cash flow model, cash flow forecasts. They are absolutely vital. I mean, cash flow forecasts are vital, and I'm sure you do them. I'll mention now, in case I miss it later, I don't know the size of all the companies you are dealing with, involved in, where you have an audit, and a very, very interesting area. I doubt it, but there may be people, I'm sure there will be people involved in charities. Charity threshold for audits, 1 million in England and 500,000 in Scotland. It's low. And cash flow forecasts, why am I going on about audits? Is they're very important where you may have going concern issues. In other words, can you confidently, as a board, the directors, the managers, can you confidently say and in writing state that you believe the company will be a going concern? So cash flow forecasting, absolutely vital. These slides are a little bit more about general principles as to how you might forecast and improve forecasting. What should we do? Challenge at the outset the business model, thus the viability of the entity or project. We live in rapidly changing and demanding times. I mean, that's absolutely true. This group of slides and some notes I produced are, I think, 2 years old. I update odd things, but basically the principles are the same. We live in demanding times, I think, and we don't know how demanding yet, I believe. Understand that planning, forecasting, budgeting, reporting should be integrated. That's often a feeling that planning's fine, great, dreams from marketing and other people, the board, great. Forecasting is done by your economists, by market people, because not often businesses, if you don't have sales, you don't have a business. So forecasting often starts there, and maybe optimism. Budgeting, you have to forecast to budget. So budget people get into it, accounting people get into it. And where do you report? Who looks at the report is action taken. So understanding the process is integrated is important. Identify how forecasting should fit in with corporate visions and objectives. And that I'm really going to come to on this whole question of purpose. I'm quite pleased to hear less of visions and objectives. Not of objectives, they're good, but visions than we have in the past. There are fads and things. And in fact, the very word purpose was a bit of a fad. It's still very much around. And again, I'm sure I'm upsetting people who have just written their purpose report or to put in their accounts, but things come in waves. Being aware of both you and your colleagues' biases. This question of bias is it comes from the world we're in, and politics is where I'll stop, that apparently we're all biased. And in fact, it's a very good thing, and it's been rightly picked up in the business world, in that maybe what we do in, for instance, cash flow forecasts, marketing people are biased to the favorable. I mean, they're happy people, they like sales, whatever, they'll come along, and your miserable accountant is biased on prudence and no, doom and gloom. But we do have biases, and I think I know there's one more slide on this, which is, it's an important thing to consider. And issues improving forecasts. So these forecasting issues, I hope, amongst points that, again, a lot of stuff you know already. You're thinking, what's he telling us? But improving forecasts and the ways of doing them, there are ways we maybe don't think of. So why forecast? Right, the obvious things, is the business project solvent now at the start? I mean, that's a very blunt thing, but build on, we must forecast going concern. Before you forecast going concern, are we solvent now? Is the project likely to work? And I will say of HS2, if any of you follow railways, I've been writing occasional bit for years. It was never viable. It was and is not viable. It's not to say that with dramatic change it might be, but it just never stacked up. There's a major project. What am I getting at? It's not to waste time forecasting a lost cause, which, unfortunately, things get proved and at great expense. Right. Will you be biased? Are you a genius? Because you're not biased. I don't think it's a genius. What would an unbiased person be? A thoughtful, balanced person. At the outset, we should face reality that only an oracle, a divine, or a clairvoyant can forecast. Anything we do is mere supposition. And to supposition is something without evidence, apparently, if you look at the dictionary definition. Now, I've been quoting Nietzsche for years because I'm an absolute Nietzsche fan, and I advise everyone to read any of his books. The translations are brilliant. And my German's not good, but he was a wonderful writer. He's not considered a philosophical academic, actually. He's not. I mean, and he wasn't. Absolutely brilliant, wonderful writing. And to quote from Nietzsche, I've done this for some time, mathematics would certainly not have come into existence if one had known from the beginning that there was in nature no exactly straight line, no actual circle, no absolute magnitude. So this idea that we can forecast and see the future, I mean, we have to be a clairvoyant and divine. So let's do things that we can do and be honest about their limitations. On Nietzsche thing, again, I have to say, Nietzsche suddenly pops up. People like to quote Nietzsche endlessly because it obviously adds to, it says a lot about how brilliant you are as a person and I am as a speaker. So if you want to look good in the world, quote Nietzsche. But he's a great writer. Understanding biases and other relevant psychological factors. This appears, and this is not where this slide came from, but this also appears in accountants and auditors, and I would have said any director making judgments. The Financial Reporting Council issued a guide, it's now 2 years ago, on making professional judgments, making good judgments. And it's not mandatory. I love it when they say it's not mandatory, but in fact, then it kind of says it's compulsory to the professions. And it goes on about biases, and it is a good thing. Availability bias is simply that when you're forecasting, oh, I've got this data here, this will do fine, and there's my forecast. That's laziness, but I can understand why I would do it. Confirmation bias is where you look at something, oh, that's exactly what I thought. I agree with that. That's the thing. It's right. The presumption is that it fits your forecasting. It's not just that you're putting in the first figures you see. Groupthink is dangerous, though it's interesting. From one side in auditing, we get told to talk to the audit team and get their views. Are you not asking for groupthink then? But you need a leader and someone to cut through it. But it is true. If you get groupthink, you get the average, I suppose, and that might not be the best view. Overconfidence, oh, that's not a problem. I'll give you a cash flow forecast. I know it all. I mean, again, we overestimate our own or other people's overconfidence in other data. There's data out there I'd be wary of. Anchoring bias that it's a bit like availability. We latch onto something and that's going to give us the answer. And automation bias, and of course, the one here is AI. I haven't put any slides in. I absolutely understand AI can wreak havoc and may well. I do understand AI is wonderful writing essays and things, and papers for you and everything else. Technically and mathematically, it is still dumb. Again, friend German happened to be. I send them. I speak to ChatGPT. It shows you how absolutely sad I am. It starts because I'm looking for something, but I sent one of my funnies. I had ChatGPT crashed for 10 seconds. It didn't come back with an answer on a mathematical thing. And the question was, what is 2 to the power 3, 2 to the power 3, 2 to the power 3? Went quiet for 10 seconds and then came back with absolute rubbish of possible numbers and everything else. And my answer was, well, it's 888, which is a Chinese lucky number. Okay, you'll say I'm confusing it. I don't know if it's that clever. I should have worked that out. Anyway, automation bias, AI, relying on AI could be very dangerous. That's what I'm saying. You would want to check things out. I mean, I asked another one on, I was replacing halogen lamps, which use a lot of power, with low energy ones. They were in my loft and difficult to get to. I know that's not the point, where they were. Could I use high voltage, 250 volts or whatever? Oh, that's definitely not. That's dangerous. Blah, 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 blah. But of course, you can get mains voltage ones. So AI, my German friends, I started on that. They said that this was because I was using the free version. If I paid 23 euros, I'd get the better version and better answer. So I thought this is someone from Frankfurt University and the Frankfurt School of Philosophy. Yes, beware of AI. I've said enough. Range of forecasting methods may be classified as follows. So let's get down to forecasting, what we might do. Qualitative, we're really concerned about the quality of the data and just how good it is. I think you've got to combine those with quantitative forecasting methods are numbers. And it's what most forecasting is about. We have numbers and we prepare a cash flow forecast of expected cash banked in a day with expected outflows, and we get the net cash flow and the cash balance. Leading indicators, they are not talked about so much now, but and they're not that common. They're wonderful if you can get hold of leading indicators. Naive forecasting is what it says, is that it's really getting at you're not expecting to hard numbers. You're being more open and thinking, which could be quite good, which is a bit like causal forecasting, I should say. I was going to say casual, but the causal. What causes things? Another way of looking at it. Judgmental forecasting is what we all do. So those are classifications. I mean, really, techniques of forecasting are the leading ones. Quantitative, you're putting numbers down, you're thinking of quality. I'm not going to use those headings to talk to. I'm just saying these are terms that people use. What exactly can forecast mean? And again, it really gets me the poor use of English today. And of course, frankly, in the broader world, it's done deliberately. I understand some American lawyer produced a paper that we should use vague words to bring about the political end of the West or something. I need to find out. This was a friend told me and I wasn't listening. But anyway, forecasting, what can it mean? Use of loose words is an issue. It means to predict or estimate a future trend. Now, two words, predict and estimate. To estimate or calculate in advance is especially to predict by analysis, which means you've done some work. To predict is to declare or indicate in advance. How do you do it in advance when you don't know what's happening? The key words are in advance. A forecast is of future events, not a mere extrapolation or representation of the past. Having said that, extrapolation for a lot of us in our day-to-day life is actually excellent and underused, and I'm going to cover that shortly. But we really need to be careful in the use of words. And on that, you will meet in the auditing world, and it's been used in various situations, the word proper. And I actually, because I was told in more than one auditing standard goes on about you should do it properly, a proper assessment. So I pointed out to the regulator, I asked them, I was very kindly as a humble person that I am, proper is not a clear word. And I gave an example from an American lawyer friend of mine who absolutely rightly got me on this. Proper is a word we use a lot in English where we dismiss something. There's Adam, this chap's name, he said, proper is a word you English use when you're losing the argument. And this crops up to this day. You know, if I'm discussing something, and it all started when I was describing a sycamore tree, which was a Canadian maple or something. I said, that's not a proper sycamore. And it wasn't indeed. But we do use it in that way. So what does proper mean? Very interesting. Do be careful with words in business. And I'm afraid today, more than anything, we really need to define our terms with people. It might be to us, it's not the dictionary definition or whatever, but at least we're making it clear. Words are used, and I feel deliberately in the world, are used to cause confusion or have lack of clarity. Right. Forecasts, now we're going to consider them under these headings. Traditional budgets, these are forecasts, often quite reliable. Often very reliable. Mature companies probably very good at it. Arising from research by the preparer or depending on sales forecasts from experts. And you can see what I'm meaning by that. We've got to be careful of our source. Extrapolations using arithmetical techniques. And I dismissed mere extrapolations, but extrapolations where you have and are likely to have a steady business can be very useful. Using leading indicators, passé now, and the exponent of that who wrote books 10, 50 years ago has apparently gone round since rather denouncing them, which I thought was a bit silly because leading indicators have place so well described them. Modeling is very useful in the sense that it gives you the chance to do sensitivity analyses, etc. And a way of fixing a forecast is to guarantee it. Now, again, if you like, banks are masters of that. You've got to give a guarantee to a loan or an overdraft. They can forecast what comes in. What they can't forecast in is that actually you're a rogue and you're never going to pay. Or just think about the bounce back loans, etc. There was no time I think there was time to make checks on people. They checked on me. I had, for one business, a bounce back loan. They checked on me because I'd applied as Ralph Tiffin, whereas I signed as Ralph. No, I signed as Ralph. I applied as Ralph Cleveland Tiffin, middle name, whereas I signed as Ralph C. Tiffin, and they spotted this, and I got a phone call, and I'd explain it. I thought, you're thorough in your checks. This is good. But they never checked company's house. That companies only existed 2 days before. So guaranteeing forecast, wonderful. And what I'm getting onto there is if check out your data, your sources, etc., because there are rogues and scoundrels around. Traditional budgets, simple budgeting. Last year's figures, same activities. We're not going to spend money on that because we've ceased using that machine or that process. Cut that out. Or we need to spend more on marketing. It's clearly the case. The price has gone up. So simple budgeting is for a straightforward business going forward steadily, if you like, or declining even steadily, but it's, simple budgeting, nothing wrong with it. Thoughtful incremental budgeting implies that, I think, makes sense for a growing business, that things do change, but they don't all change by 10%. So you've really got to think about incrementally some costs will be truly fixed. You get into the question of fixed and variable costs here, and semi-variable, and all the stuff that management accountants love. But there's a place for it. Sales forecasting is vital as a topic on its own. Likewise, cost forecasts and commodity forecasting, currency rates, etc. That's a type of traditional budget that is very relevant to a lot of people. So those are traditional budgets. They have their place. Again, my point here is simply, are your budgets appropriate for what you're doing? What does a mature company need? Thoughtful incremental budgeting, sales forecasting, and cost forecasting, of course. Own research, something we should do or maybe do more of. A key issue for success is for forecasters to really understand business, economy, markets, customers, marketing, strategy such as it is. You're right, these are lecture slides, these are what you know, but should we do more of our own forecasting? Businesses, large, small, are hardworking. I mean, clients I've got, it's not like the good clients that I had, they're super. They informally do all this sort of thing, but even there, there's a change in ownership, change in structure coming around. They are going to have to be more formal, and I think they'll get even more out of it. So, should companies be asked to do more research, their own research? They know their place. They also might find there's a gap where they don't know the market as well as they thought. So, own research, very important. Ways to improve your own research, taking time out, using everyone's brains, brainstorming, logically ranking issues, using appropriate research methods if needed, guaranteeing as many elements as you can so you don't waste time on them. And I must have been prepared this originally for accountants. Speak to your clever accountant, of course. Yeah, own research underdone, I would say, in even good businesses. Research surveys. This may well be an area where outside specialist help is needed. It appears easy to ask a few relevant questions, get the answers and conclusions. The design of the questions can be very much about the outcome. You can get the answer you want. I'm very wary of surveys, exceedingly wary, and even doing your own survey. I mean, in one case, someone thought of opening a restaurant. Oh, ideal, we'll open. This is a year or two back. We'll open from breakfast through to dinner, get value out of the property and the machines. We'll have different staff, but get the capital invested at working, if you like. And they said, oh yeah, we'll sell lunches. But they did their own research and found, well, the idea is that people have lunch is true, but it was in the centre of Edinburgh, in fact. The lunches, when they looked, and they did some research other places, people came in and looked as if they were sitting having lunch, but people arrived late, to meet up. They had a drink and maybe a sandwich or something. They did not have a lunch. It took a chunk out of midday revenue, if you like. So surveys very important. Our own checking of them important, but again, professional help may well be needed. Extrapolation. The dismissed slightly earlier on as mere arithmetical, whatever, but where you have, doesn't have to be steady, but certainly you can do sensitivity analysis where there's a range of the future activity, if you like. I'm moving my hand as if I had an audience in front of me. Informal explanation, this is what we often do with budgets. We extrapolate forward. It works well. As with any forecast, the rationale should be explained to all using the forecast, and the assumptions should be tested. But extrapolation, informal, nothing wrong with it. Graphical extrapolation, and this is where I want to make the point about, periods and deluding and fooling yourself. This is a series of income figures for part of a restaurant over 52 weeks, as you can see, 52 along the bottom, and the area concerned, the weekly figures there. We have the series one was a business growing. The series two, the purpley magenta colored, business going down the pan, and serial three, the business went bust. Right. If you had the green figures, you were going to stick at it. It was going up. It was a very, not just seasonal, it was events driven in this particular town. So really ragged. If you look at it, there's there is quite a similarity between the dates and the amounts, but it's definitely the case that the first year is slowly growing, stick with the business. Second year should have given you warning. The orange figures started low, which should have been a warning, and going down. But so extrapolation, a clear indication in year one that this business is bust, but it didn't go out to business and loss of money for a year and a half. Why? It's a hard thing to say, I'm going to give up. Misuse of graphs. Look at the figures, and I'm not saying deliberately, but look at the figures over the first part of the year. Green on its way up, magenta on its way up, and even year of closure, almost steady, but actually a very slight rise. You really have to be careful with graphs. And I mean, I was close to this disaster, if you like. The director saying, "Oh, everything is fine." They were looking at the week. They were looking at the 3 months or whatever else, rather than looking at the whole picture. So extrapolation, I'm not saying extrapolation is dangerous. I think extrapolation is very good and should have been used seriously. And in this case, it wasn't. Totally different type of graph. And this, again, predictive is, again, very helpful. This would be for a contract. So simple stuff. We have an estimate or forecast in black. We have the budget, which was costs going to be hit by August. The costs are going to come in. It's a question of how you get there. But the budget was to be hit at an amount in August. The actual figure was the orange figure creeping up, as you'd expect with a contract. It was construction work, so it was building up pretty steadily. So everything was looking good. The project was meant to end at, I think, 1800 or thereabouts in August. And the estimate or forecast was done fairly informally. I mean, some of it was cost incurred and on site. Other things were an opinion of a director or a quantity surveyor, people involved. So if you take the graphs, yeah, the black and the orange are getting there. The green is where you're going. And what we want to do is predict where we'll be. So the forecast went up to the July, really, and they were wildly out because, I mean, often as projects, they start, overspend, get it into trouble. So it was a way out. They were bringing it back in. They were then steadily bringing it down. What is the point of this? If you extrapolate forward, the two black lines meet at when you now will finish and at what price. So you're going to finish late. It actually, but this one brings in time. You're going to finish late and at 1900 or whatever. Wasn't far out. What I'm saying is predictive graphs can be very useful from real trends. The key one there would be the estimate or forecast, how good it was. But you were on the way there, and putting on the trend lines can be very helpful. So I personally, I've seen it in use. It's not just my opinion; it's been backed up by and use. Appropriate predictive graphs with trends can be very helpful. And there we have it again. I'm not sure why. Leading indicators, another topic. And I'm just checking my time. We are going to have a break. Don't worry. I'll deal with this and we'll stop for coffee. So I won't rush, but it doesn't take long. A good idea arising from balanced scorecards, and that's the thing that was talked about. Kaplan was the name of the author. Great book. I've still got it. The idea from balanced scorecards. It's where we shall be. It's a forecast. A leading indicator is a figure or ratio that tells us where we shall be, which is great. We'd love to know that. And there are some examples. Sales last month, leading book sales next month. Sales last quarter, order inquiries for next 3 months, times a conversion factor. In other words, you get order inquiries, but you've got a good history of how many become orders. So that's lagging indicator is all history. It's fact, which is good. The leading indicator is where we might be. Product faults per month, product improvements proposed. Sales returns last month, customer complaints would be a 3-month trend. Machine utilization last month, budget machine utilization next month. What are leading and lagging? Well, they're down as lagging and leading. What are genuine leading indicators? A is something that provides an indication, especially of trends, depending on how one comprehends things. So a leading indicator is something that provides an indication of trends, and hence trend lines are good. A thing that indicates the state or level of something. This is just the word indicator. These are dictionary definitions. To be a genuine forecasting tool, leading indicators have to be more than suppositions or extrapolations. I would knock out all the answers C and D as being simple predictions. You might like to go back to these slides if you're fascinated by this and see which fit in. B is only genuine if conversion is certain. Interestingly, E, which is the weakest, is given as an example in the book on balanced scorecard. To sum it up, I'm going to leave you to look back at this. To sum it up, restaurants have good leading indicators, and they use them daily to get part-time staff in. And they have indicators for months ahead. A really good, expensive restaurant will have good indicators. They'll know their bookings for 12 months ahead. Hotels have a good idea. Airlines have a good idea, because actually people are, and if they book advanced fares, they're putting their money where their belief is. So leading indicators are around and there for these sort of industries. The reality is there are not that many leading indicators. A lot turn back to be suppositions or opinions. But look out for them, is all I'm saying. It might be a very good idea to look out for them. And I've asked the question, I will ask a question here. Which of the following may be leading indicators? Advanced ticket sales, absolutely. People have put their money where their beliefs are. 20% growth in sales to date. No, I mean, it may be a trend and it may help, but it doesn't guarantee anything. Conference center bookings, absolutely. And commodities market forward oil prices. That is, in the sense that the commodity market's independent, could well be. But let's have a break there. We'll come back to models. So we'll break now, and if we can return for 10:15, please. Yeah, 10:17. 10:17. Thank you. Right. Welcome back. I hope everyone can hear me. Looking at modeling. But before I do this, one question which was interesting, and I hope relevant to everyone, was a question of forecasting for a charity. And indeed, this is something I meet in auditing quite frequently. And in particular, there's a case just now ongoing concern. The charities depend on funding, some significantly from income they earn by running a cafe or whatever else. I mean, that is their business in a sense, but most from funding, a lot from government funding, um, private funds, wealthy people's funds that leave them money, give them money, fund them. And today's climate is difficult, very, very difficult. So in this case, I'm thinking of the department that will give the major part of funding, doesn't know where it is because the government is taking time to best allocate resources. So there's simply uncertainty. Will they get money? Well, they might not get any at all. So where you depend on funds, or you're going round the funders that have given in the past, maybe their income has fallen and they're not giving so much. So again, you just don't know where you're going. You do a cash flow forecast and have it what is certain. And from a point of view of an audit, going concern, ideally you would be clear that you are going to live forever, but that isn't the case, often the case. You've got to look at a year from when the accounts are signed, and really beyond that, of course. So I can think, and the question was, what do you do? Well, you produce a cash flow forecast, and if you are really uncertain and can't see where you're going, then there will be a qualification in the audit report. I mean, and the trustees will report that there is a material uncertainty about survival beyond, let's say, 20 months or whatever. And it's not a case of getting around that, but not to be able not to have that qualification to make that statement, you would have to be sure that you've got sufficient funds to be viable for at least a year from when you're signing the report. And I think a lot longer, you need a good, reliable cash flow forecast. But it's interesting that with COVID, the Financial Reporting Council said of businesses generally, I mean, an easy option for companies and auditors would be simply to say, oh, there is a material uncertainty due to COVID, which for a lot of companies was going to be silly because it wasn't the end of the world. I mean, we didn't know it wasn't the end of the world, according to some people it was going to be, but, you know, we weren't, you know, we knew enough to know there wasn't the end of the world. So a lot of businesses would keep going. So just putting in over not sure, uncertain doesn't do anyone any good. You've got to take this material uncertainty seriously. But if you've got a cash flow forecast, in the case I'm thinking of, they have enough money going forward for well over a year after, and included in there, as charities have, they will have reserves. Included in the reserves is a sum to allow the company that it is a company and a charity to run down to zero, to actually liquidate. I mean, that is a possible outcome. And stating that may prod some funders into, well, we need to help this wonderful charity. So difficult area, but enough on that just now. Back to models, real figures or a dream. A model that demands the user inputs all the interesting and hard to predict figures is not a forecasting model. It's simply a calculator pretending to be a forecasting model. The model simply applies some arithmetic to judgments provided by the user. And with great show, clever Excel formatting, you have a forecast. So we need to be wary of people's forecasts. It's more than, it's got to be based on reality. Modeling often uses extrapolation, and thus models do not really tell you what the future holds. I'm being cautious on extrapolation, but extrapolation is grounded on reality, put it that way, grounded on reality. And therefore, that's, I would think, quite appropriate. And for something like a construction contract, I mean, reality is really pretty contractual, if you like. Models can indicate outcomes. Of course you can, you know what to avoid. Models will be more reliable where the data is regularly updated. And sophisticated models with many inputs can be very powerful, but equally dangerous. So, I mean, I think you're aware of this. So that was a sudden end. I knew I had a little bit more to do on forecasting. So yes, beware of models. if you ran models of HS2 as I've done over the years, figures, I actually said at one point, you're going to have people at gunpoint put on the trains, filling them at Euston. And this is the problem. It's income, passengers. It's a real problem for the railways today, generally. We have crowded trains, but there is a lack of income. And it's not just in the UK. This is a European issue. Very interesting. Anyway, I'll start diverting into the economics of railways, which is not the purpose of today at all. The purpose is, why be in business? That's my title. But what I want to look at is this whole question of purpose, and what's behind it, if you like, is very important. Purpose, it was a sidekick, I think, of I know it was a sidekick of Bill Gates, who wrote books, great guy, and I think rightly said there's more to life than return on capital employed or return on equity. Purpose is important, and it's a good concept, but I think you've got to go behind it, if you like. Reality is unfair because purpose is a reality, but to get to the heart of why purpose and how we deliver purpose. I mean, let's face it, it's about delivering purpose. And what is purpose? Should we start with philosophical or not? Certainly philosophical, yes, and no more Nietzsche, don't worry. One definition of the meaning of life, I'm not joking, the purpose of life, it references purpose of life, but that doesn't answer the question. So the meaning of life is the purpose of life. What is it? The property or quality that distinguishes living organisms from dead organisms to dead organisms. Presumably, you wish your business to be a living organism. I would think you do. So you need purpose. I mean, so this supports purpose. Purpose, a definition, the object toward which one strives or for which one sometimes, of which something exists. An aim or a goal, that's the Free Dictionary. So I think purpose is a good term. The idea of a business's purpose, and just touching on the maturity thing, if you're a mature business, what is your purpose? Have you lived your purpose? Is your purpose just to molder on? Some mature companies do. It's a very good word and very sound idea. The point for today, though, you may be clear on your purpose, but is there or will there be a desire or better a need for your goods or services? I mean, I think that is a key thing. And as if we didn't know, we all see it. Some businesses, I think we've all been a business, a shop, and you'd be kind if you told them they're dead, but that's not a kindness. They're not going to appreciate it. We really need to ask, is there a purpose for us in the future? Why the current focus on it? Well, it goes way back to 2006. Concept of stakeholders came to the fore with 2006 Companies Act. The term and notion has been around for a lot longer. Could the focus or purpose simply be because a few businesses appear to focus solely on extracting money from businesses and thus humanity? That's my cynical point. To address the issue of narrow focus on money, we have the idea of the responsibility to stakeholders. A stakeholder, one that has a stake in an enterprise, one who is involved or affected by the course of action. That's Merriam-Webster. So why am I quoting back to 2006? This is topical. The Companies Act 2006, and we're talking 19 years ago, 18 years ago. The Companies Act was beefed up. You could have said that the directors of a company and the owners, I mean, the company as an entity, they should take a wider responsibility. It's not just about me, the company. It's a wider responsibility. And indeed, 2006 Act refers to responsibilities. We then had the strategic report brought in, depending on the size of company. For a large company, you're to talk quite widely about responsibility for employees, suppliers, customers, etc. The question of where this stands is topical in that, I mean, I see it very much from the audit side of the world, that we auditors are not doing enough, constantly being told this, and indeed there have been failures which are blatant, I suppose. I'm not so sure amongst medium and small companies. We never hear of the failure rate and the lack of involvement, I would say, of auditors. But I mean, yeah, auditing globally is not getting good reception. Um, One thing, therefore, governments, and not just in the UK, but the government in the UK is moving towards tightening up the audit profession and governance, and how it will be done. But certainly, I think there's a will, and I would have said a good reason for more responsibility of company directors, and in the wider sense of the wider purpose. That's what I'm coming to. So, something to look out for, something you'll be, I'm sure, fully aware of already. Purpose often morphs into values. Values are often platitudes, caring for stakeholders. Indeed, we must consider others. You know, I'm obviously not keen on the values. It's again one of these vague terms. Our values, they're only going to be positive. Um, the slide that follows this is refers to stakeholder cube. You might like to use this, study it for a minute, then just one choice, vote what type of stakeholder is your bank. And I'll give you my view since we're not set up to voting here. Just have a look at it. It's this classic management stuff, attitude on the left there, interest along the bottom, move around the circle, the cubes of different colors. Have a look at it. Yeah, the generality is that what kind of shareholders do you have? People that affect you generally, and I've taken to specific of what kind of, where is your bank in this view of people? An irritant, a tripwire, time bomb, terrorist. I really should have arranged a quiz. It'd be good. I just go around them. A tripwire, passive blocker, just a nuisance. A time bomb, influential passive blocker is wear with you more, but blocks thing, a nuisance. And acquaintance, insignificant, could block, and not if they did, it wasn't serious. Sleeping giant, influential, passive backer. Now that's what you want, I'd have thought. A savior, that implies you've got difficulties, but they're there, they act, and in your best interests. A friend, but insignificant. A terrorist, an influential, active blocker. And that's what some of these, there are investors who take a large chunk, and they do good as well, and not just a nuisance. And then an irritant, an insignificant active blocker. So where's your bank? Uh, I would hope they were just irritants. That they obviously can block, and one hopes that their effect is insignificant. It may well be you've got loads. I'd have hoped the effect wasn't the end, but your bank could be the terrorist. I would guess your banks would like to see themselves as sleeping giants. Oh, no, the banks would really love to be your savior, wouldn't they? Uh, that's a fun thing to look at. If you want to have a discussion about your investors, who they are, and who you should look to, bring this out at a board meeting or whatever. It's actually super slide. Anyway, so we have to consider other people, but we're also affected very much by our investors. Large companies are having to, as ING missing it, to consider and report under the company's miscellaneous provisions, which was triggered in 2018 from the 2006 Act. That's why I went right back then. But it's, again, not so, it's more recent, but not so recent. It's been around for a while. Section 172 disclosures. And the key thing states, a director of a company must act in the way he considers, in good faith, would be most likely to promote the success of the company for the benefit of its members as a whole, and doing so have regard to, directors have regard to, there's the list. I'll let you read it. And now what I'd say is that companies may regard this, and some will say they do, and some genuinely do. But how can I sum it? I don't think anyone is really worried because, I mean, the very wording is have regard to. It's these activities that, from a governance point of view, the FRC as a regulator and other bodies may want to make rules. There is, again, it's not just UK, globally, we're moving to a legalistic world. Apparently, we need rules to be good people. That's a philosophical topic for another time. But I think we should be aware that your purpose can be whatever it likes, but we do look, and we have to look more to our wider responsibilities. I put it that way. Is your purpose genuine? And this is talking back the way. Does it manifest itself as simple platitudes in the strategic report? Do your board and all employees know and understand your purpose? So, I mean, the word purpose is good. I wouldn't drop it at all. It's got a harder financial issue behind it, and it's got this, I think, growing social issue coming along. These I put up as coming from accounts a couple of years back. Just read them. Now, I forget who's which, but I know for sure, I forget the name. I'm not doing it accidentally, I genuinely forget. Purpose and values, would you believe, is a bank? Yeah, that's what banks do. And the group purpose, I think, if I get it right, and I think that's Virgin. It's a good, snappy title. Changing business for good. Oh, good stuff. And two more. Now, one of those is a liquor company. They could both be bringing excitement to life and the purpose of celebrating life. But the purpose of showing them is that in financial statements, you get statements like this, which I don't think really help. Fine for marketing, whatever, and positive stuff. But purpose is a lot more serious. And I'm going to focus on the financial seriousness, if you like, but it's very serious also from the governance point of view, and likely to be more so. Some further considerations. Does purpose depend on who owns the company? What are links with company culture? Will corporate purpose change as a result of today's environment? And the answer to the last one is most certainly yes. The corporate purpose delivery will change. Our links with company culture, very much so. Does purpose depend on who owns the company? I have to say, with large private companies, I think the purpose is very, very clear, and generally very responsible, if you like. But these are considerations for what is the place of purpose. Living your purpose, whatever your purpose, it can be more focused in, linked to strategy and tactics, linked to forecasts and budgets, clarifying what your risks are, clarifying what has to be controlled. So I'm saying purpose is a key thing, but it's not there on its own, and not some fluffy, pleasant words, if you like. It really has to be linked to how you're delivering financial results. And this brings me to the core financial thing, and returning right back to the beginning, return on capital employed, and just touching on, you could maybe look at, I'm going to go through at a reasonable pace. If you're fascinated by them, just look at the numbers. To me, the numbers say all. But what I would say is a business at the start, growing, declining maturity, whatever stage, looking at why be in business from a purely hard numbers point of view is essential. And I'm sure you do it. The good companies, I'd say the private companies, I'm talking companies with 30 million turnover. There are a few at that level I audit. Totally different section of business, type of industry. They all probably do not look at these ratios constantly because they're totally on top of the constituents that matter. Therefore, if the constituents are right, the business will be successful and grow. So you don't need to look at these ratios every day. The one large group I admire greatly, and I wish I'd bought shares in first time I came across them 30 years ago. They have grown steadily since. Absolutely wonderful business. Culture is great. It has the culture of a private business, though it's listed. Tell you no more than that. But they are completely focused on investment and making return on capital employed, but they actually will override the hard number at times where politically, appropriately, economically, it is better to take a slightly lower return. So they're not foolish. They're not, they're not slaves to the highest return investment. But they look for a return at everything they do. Absolutely superbly run company. I've worked for various reasons at various times. Sometimes they didn't know that a unit didn't know that I had actually done work with them before. The best comment I got, it was on a cost reduction exercise, was that I could be the company Rottweiler. And I was so proud. I told my wife, she thought it was terrible, but I thought that's a wonderful thing, knowing they're a tough company. So good companies look at return. Large companies, corporations, smaller businesses do as well, but they tend to do it in a less formal way, and that's fine. They look at the constituents. So what am I going on about? What is our ROI, return on investment, or return on capital employed? It's the operating profit from normal activities before tax and interest charges divided by the capital employed, used to generate profit. Operating profits to be found in the P&L account. Understanding the drivers of profit is essential. Margin enhancement, wherever with us, cost management reduction. So this is where your average company, your private company, smaller company, the good ones know all this, that enhance your margins, of course. Keep your margins up, try and enhance them, and manage costs, keep them down sensibly. But, what's my but? But you've got to be careful of that. I mean, you might be better to accept a lower margin and more business. You can't be slave just to this diktat, if you like. What about capital employed? Capital employed can and is viewed in two ways. It can be viewed as the physical capital employed, or capital employed can be viewed as the money invested, shareholders' funds, investment in shares plus retained profit, and loans from lenders. Your viewpoint may well affect your purpose. And that's why for and against private equity may be totally against. In my innocence years ago, I thought private equity meant private company not affected by the whims of the stock market and the indexes today, and we should do something, but long-term investors. And of course, that's not what they are. So they are what they are, and they manage to pay less tax. But private equity, what's in its favor? They will shake down rather mature, maybe, but rather unthinking, plodding is a good word, companies. So purpose depends very much on, purpose depends on how you perceive capital employed. As far as I'm concerned now, forget who's investing and what measure you're using just for the moment. Nobody's going to get a good return on investment if the capital physical is not employed well. That's an important thing. That's really what these series of ratios tell us. These are, and it's interesting, they're making a return of 20% retained for years for even different sectors. So retail, manufacturing, the Tesco's, Sainsbury's of the world, 20% return every year from the accounts, that is. The operating profit over the capital employed, it was at that level. Food manufacturing engineering companies might be 18%. I mean, there were ranges. A utility like British Telecom, BT, telecoms utility would be down at 12%. So there were ranges that, why would I invest in a utility? Because it's guaranteed income. And of course, that's why private equity bought up the water companies. And that the mistake was maybe allowing that to happen. Their purpose was very clear, guaranteed income, and as we'll see later, gear it up and you're with it. But just sticking with these figures to make the point about return being important. How do I deliver return? I deliver it with good operating profits. So here I've got a 10 profit over 100 of sales, 10% profit, very good. That depends on the industry, of course. And asset turnover is the sales to capital employed. This often shocks people. And again, different industries quite different. And today, with your virtual world, capital employed is almost zilch. But classic Sainsbury's, a classic manufacturing company, for 100 of sales, they would have to have 50 million, billion, whatever, of investment. And that ratio, that always shocked people, actually, it was so low. So the question then is, if that's your base model, which could still be today, is for some companies, that's your base model, how can we play around with it? How can we demonstrate that focusing on return on operations is important? If you make a higher margin, you make 30% return. Simply higher 15 there on the 100. Of course, it puts it up to 30. Hardly rocket science, as the saying goes. Even AI could work that out. I must ask them one day. Right. Higher sales volume strategy. So 10% still. And if we can sell more, 6 asset turnover to 1 asset utilization, a 6 to 1 ratio, if you like, we can sell more. Of course, you're going to get a high return. And down below there, I've got sort of suggested figures for the sales and cost of sales. If anyone wants these spreadsheets, so you could replicate them dead easy to play around with things. Lower sales, but higher margin. So can you live with lower sales? Sales down to 70. I've got these on the sheet here. So my capital employed is still the 50. My sales are falling. Asset turnover is not 2 to 1, disaster. But if I can get the operating profit up, so what's that telling you? Sell watches, high value things, and I don't need to sell so many. You have options, or for a lot of us, we don't have options. But I think understanding this is very important, and your purpose has to have the arithmetic that matches it. And likewise, your arithmetic has to align with your purpose. So different ways of delivering return and return you need. I mean, how it's carved up between banks, lenders, shareholders is a separate exercise. If you don't make 20% return or whatever a good benchmark is, then you can do all you like, you're still only going to make so much of a return. Lower margin, higher sales volume strategy. So here we have a 5% margin, but very much higher sales volume, the two again, and we come back to 20. I mean, you can come back or come to your desired return in many ways, but this is exactly what the private company that's growing and doing well knows. They don't need to calculate these figures monthly and have a report. They know that sales need to be steady and growing. They need to know that margins need to be 5% or if better. They need to know that costs need to go down. You know, they can look at the constituents and read their sales and costs and margin. So no, I'm not telling you anything you don't know, nothing new or revolutionary here. And lower capital employed, cheap is good. So we've got operating profit 10, we've got sales of 2.5 to 1, but we have lower capital employed. What that does suggest is that and we see this all the time, rationalization, shut down factories. I'm using the word factory, but shut shops. We can all see, and we have seen, outlets that should never have been opened in retail. I mean, we know because we go to them and they're quiet and it's lovely, but we know they're not going to last. So lower capital employed has been the drive. Today's the purchase cycle, if you like, the supply chain helps very much with this lower capital employed. We don't need a huge warehouse to store before we produce because it's delivered daily. That's just taking out capital employed. So in all of this, there's no rocket science, there's nothing you don't know. And likewise, it's why mature, growing, good startup companies need to know this, which I think intuitively they're business people, they know. So that's why I've included this important stuff. No end to, you'll say. Higher capital employed, life cycle costing. I'll give you a higher return if I invest in better equipment. And it was Henry Ford had a quote that if you need a piece of equipment and you don't buy it, you pay for it forevermore. In the sense that simple sense that you'll be repairing the flapped out bit of machinery. Buy the new one, it takes a hit, capital employed goes up, but it's efficient, uses less electricity, and doesn't need repair. So life cycle costing, talked about endlessly. A survey some years back, I bet it's not changed. 65% of large companies, corporations globally said, we believe in life cycle costing. Only 28% did. And the problem there is the shareholders are looking for the quick buck. And to take a dip to find the money, it'll affect some other ratio, it affects their gearing ratio because they borrowed more to buy a better machine for the long term. Life cycle costing, I can't believe in it enough, if you like. I would push it every time, but I'm absolutely aware of why it just doesn't get done. Other reasons, and short-termism in the sense, why buy a new machine when we're going to sell up in 5 years' time? But I think if I were a private business thinking of selling up, I would get the equipment. I would show that I was even more profitable and I wanted a higher valuation of my company. But anyway, over to you on that. Right, the question of gearing, shareholders' return on investment. This is where we move from capital employed. 50, 40, 10. Here, if we look at the left-hand side top, you have capital employed of 50, loans are 40, and equities 10. So there's 50 of funding and there's 50 of capital employed. The capital employed is the return from capital employed I'm giving you is 10. The interest to be paid is 3.2. So you've got to pay that. The profit after interest is 6.8. The return on investment with the after interest charge is 14%. Percentage profit 6.8 to 100, 2 to 1, asset turnover, etc. But the shareholders' return on investment is 6.8 to the 10. This is, I mean, basically what I'm saying is the split between low interest charge loans, the loans, they are getting a 10% from an active business, whereas the interest has to be paid is only 3.2. I don't think I'm explaining this very clearly. I think you need to study it, put the light on, but do have a look at it. It does make sense. Oh, yeah, I skipped and got on from that. I should have done better. I should have put more slides in there. I'll get a plug-in for a book, and I don't think I have a copy behind me. A book that came out a few years back with Kogan Page, Executive Finance and Strategy, has all these sort of slides in it. And you'll find them in probably any textbook. But purpose, coming to conclude on purpose, the return that people talk about, you've got to be careful. Is it return on an equity, return on investment, and figures bandied around? Who are you? And in a sense, what is your purpose is very true. So check your purpose. Where did the idea come from? Why the current focus? Who are stakeholders? That's the introduction again. Do think about your purpose, and as whatever you involve in the company, think about where you are in delivering return. The question of how it's split is for finance people. And a lot of you out there are going to be an awful lot better at this than me. I've never really been in, if you like, the banking finance side. I see companies from an audit perspective, but from work on real projects and other things as a practical thing. Can we make money out of this investment? Can it give us a return? But enough there. Not quite enough. What is your purpose? Is it achievable? Cash flow forecasts are essential. Yes, absolutely. And I think that's test with an appropriate model. Very, very important. The cash flow forecast, going back to where we started, working capital management generally. Right. Different topic. We'd have hours on this, but we're not going to. Just some thoughts. Uh, why budget? Question I often ask, I start, if I'm talking of budgets, I always have on budget to control, to plan resources, to plan cash, to achieve a goal, to manage the business, to achieve the business's objective, to fulfill the business strategic plan. What is the main reason? They're all good reasons, absolutely all good reasons, but ranking them, you will maybe disagree. To achieve a goal, to plan cash, you take aside, that's the cash budget. That's you budget. I'm asking a question here, make it clear. Why do you budget sales and costs and profit? And the answer is 1 to 7, but cash is a subset, which is vital, turning it into a cash budget. Why budget cash? To survive, to make sure you've got enough, to make sure you're a going concern. But to control is often seen as a reason to budget. It's interesting talking to management teams quite often, and I'm thinking not finance people, but people in marketing, sales, engineering, production, delivery, whatever. But if you ask people there, they'll often say it's to control because that's all they feel it's about. And indeed it is. I mean, you have budgets to control departments and activities and etc. But achieving a goal is important. Managing the business generally is another control thing in a more general sense. And the strategic plan, okay, fair enough. The one I always go for is the business's objectives, which, of course, from what I've been saying, just personal view of companies, has to be about making a return on the capital, active capital employed in the business. Okay, so I am going to pause there in case I don't say this at the end as a roundup. Those of you involved in buying and selling companies, a company could show with audited accounts that it makes a return of 20%. You have to be wary on the valuations of particularly fixed assets, obviously, because the capital employed could be a distorted figure. Accounting standards today really require property, for instance, to be revalued, so that would be up to date. Machinery should be at its cost or lower if it's impaired, but it might be worth more. So, and again, I'm talking to people who I'm sure know too well that in a purchase of a business, you are going to look at the cash flow it generates, the profit it generates. You're going to look at the capital structure. The key thing you have to look at is the actual valuation of capital employed, because you can get good deals where the owners and maybe a mature business do not appreciate the historical, the values are historical, the values of their workshop or whatever. So I must say that now in case I miss it later. But back to budgeting, I believe it's very much to achieve the business's objectives, which should achieve strategies, a sort of grander, fuzzier title to me. And objectives should be cost control, sales growth, return. Stages of the budget process, therefore, have clear objectives, arrange the strategy and tactics. It's maybe have a strategy, have objectives, and then the tactics to deliver, prepare the plan, implement it, and monitor performance. No rocket science in any of that. But a lot of budgeting is done without stated objectives. Okay, there may be known and as a given, and you can't do anything about them. But I mean, in designing budgeting systems that I have, I mean, I think very important to make clear what the objectives are in writing. An aligned culture is key. What is your culture? Tough or easy, clear or ambiguous? Right, let's deal with clear or ambiguous. Again, I would say that reporting process should be absolutely clear and no ambiguity. It doesn't let people off the hook. People know what they're working to. It's honest, if you like. Is your culture tough or easy? Well, it shouldn't be easy, but again, tough, just shouting at people isn't good. You know, an accountability culture saying that this is your area. Costs have risen. We had a meeting, you said they were under control and they're not. What can we do to help? And you yourselves will know you're going to meet completely different cultures and different companies. And different cultures are appropriate to some different businesses. I would have said over the years, and I think now, culture is not good in a lot of companies. And I know from, friends, younger people would say they move to a company, say, oh, it's great. I'm clear on what I do. I actually like it. So culture is a key, and an aligned culture with budgeting vital. Elements for success, understanding the business imperatives. This, again, that's a word people like to use. Identifying where the best returns will be, participation and ownership by management and staff, strategic context, positioning and capability, the customer perspective, internal and external. What does your customer need? What do you think they need? What do they think they need? The customer thing is vital, again, from experience. Here I'll touch on something because it's topical. Me, I've got one client which has become management ownership trust. And I'm going to be very interesting to see the change there. But it's a very well run, good culture company, successful, moving from maybe singular, clear direction from above to a board. It's an interesting change, but participation and ownership by management staff can be very helpful. Hydrings, it needs good characters to manage it. And what I'm saying is not a dictator, but it needs a very clear leader, put it that way. So key elements of success in a business: leadership. That's easy for me to say. So those are some thoughts on budgeting. Again, old hat maybe. If you want, whether you're mature or growing, an appropriate budget process down in writing, useful thing to have. And so the board know, and employees know, and everyone knows what your line of thought is. Cost reduction. What does cost reduction mean? This is very much with us. There are articles, because of the environment and the new government and costs are going to have reduced. Well, what does it mean? What can we do? So again, just a few slides to maybe make points you might find useful. And as a mature company, do you want to reduce costs? Yes. The worry with mature companies that are successful is that they are successful and they get blasé about it. Cost reduction can mean lots of things. You cut costs, and that has to be done. Sometimes it's just simply, we need to cut that cost, not spend money. We will not have a Christmas party, whatever. Strategic implies, and it should be focused, that, and it could mean as dropping the in-house printing company. That was something. I mean, gosh, the things that have happened and will still happen. Every insurance company had a printworks nearly in Britain. I bet some still do, actually. But I mean, I saw either working with them or audit or for whatever reason, visiting different ones, that a job finding an assurance company, an insurance and assurance company. You'll have a job finding them that have their own printworks. Why? Because there's plenty of printers out there desperate for work. It's a supply chain thing again. So cut by strategically changing how you do things. Purchasing, supply chain, etc. And again, the company I much admire, I was involved in purchasing, and that's the Rottweiler comment came from that their exercise was to improve purchasing, centralize it, obvious, maybe all things with hindsight pretty obvious, but how you purchase, from whom you purchase, etc. Very important. Cost reduction can simply mean better budgeting and control. That you have budgets, they are fairly good, but who cares? Nobody needs to get into a rage and anger, but certainly use the budgeting process, which you have to do. Cost reduction can mean capital expenditure. Money being spent, capex, that you automate. I mean, and that's happening quite cheaply, of course, with I'm going to say with AI, with phone answering, with whatever else. We don't need equipment. We buy in, but we automate as far as we can. And the process is appropriate for some businesses. Construction process, we've seen it change over the years. We've continued manufacturing processes change. So cost reductions has a really wide range. Cut is maybe the only short-term one, purchasing too. if you think about it. Well, housekeeping I skipped. I mean, good companies tend to be just good housekeeping. They're tidy. I mean, to me, I've visited so many companies. It was a mark of a company when you went to the visitors desk. You arrived at the company. You can almost say at the door just what kind of company this is going to be, and the budgeting would match. Their housekeeping was good. Their whole approach was good. So cost reduction can mean a lot of things. Why does cost reduction fail? Well, costs will always creep back into business and into budgets. They just do, but it's back to good budgeting, um, challenging costs at every turn. A reason would be that the cost reduction, or at some stage, you just got rid of people. I mean, it really, someone has said, right, we're going to cut costs by 10%. Well, why didn't you do it ages ago? And what were they not doing? And should we not cut them by 20? It really is a crude thing, but of course it's the easy thing to reach to go for. Just get rid of half the people. Because if it's in a company where labour is a high cost, and I'm afraid that will continue. And it's done ignorantly in a lot of cases because costs just don't creep back. They come back because they should never have been got rid of. So issues there are probably obvious to you. Weak leadership, I mentioned that with budgeting. Lack of ownership of costs. They're not my costs. Who cares? I just buy stuff and I do what I do. And where the accountant can help, lack of performance measures. Really going through the figures. And I'm often shocked, since I'm not running a business day to day. Well, I'm involved in one, but there's very few employees. But it's interesting that I'm amazed in seeing the way I go about things and the way I go to a good company, the performance measures. Some would say, gosh, this is very pedantic. Not that they take time. Pedantic's not the right word. This is very detailed. Why do they do that? It's obvious, but they still go through the process of getting people in, questioning the budget, whatever else. It's taken seriously. So I think lack of performance measures from finance people, and let's face it, with modern accounting software, everyone can get a report. You can tailor them, etc. Trouble is with this, you can get lost in looking at reports and the business goes bust. So balance at every turn. Customer focused costing is interesting, where you actually look at what you're supplying and delivering service you've given, and is your costing, does it match? Does it link to what you're selling? Costing can be reduced by complexity reduction, process simplification. And I bet that's something that creeps in. Complexity creeps in. Of course, today we have more and more regulation. How you deal with the cost of regulation. And this is absolutely the case. And again, not just here. I mean, I work in Germany and other parts of Europe and overseas. The complexity comes in, regulation has come in and will come in. It's just in the political, it's in the ether today, and that costs money. Complexity is a killer of entrepreneurship, but it is, and the particular regulation is definitely a killer of entrepreneurship. But it's for our politicians to see that. Life cycle costing, I poured on about, makes great sense. Detailed costing, cost awareness, and we have things like activity-based cost management, budgeting control I've talked about, and procurement I've talked about. So these are touching on things I've already mentioned. Again, I just hope for some of you, awareness that you do all this and fine, that's great. You've not totally wasted your time. Or for others, yeah, this is an area we could look at. All right, talking to my clients, you're financing involved with in whatever way, it will help you. Customer focused costing. Target costing is to meet the cost, the price, which it's quite good. Rather like design to cost. I haven't heard much about these since a few years back when I was involved in them. I'm sure they still go on. Design to cost is great, and I like it because I think things are over-engineered. Just as a personally, designs of kettles and things are faffy nonsense. I would like an on-off switch, and that's it. It says the Neanderthal. Here probably am. No, design to cost is what you want the product to do or the service to deliver, and we do that. So what is the minimum cost we can get to do that? It's not just get the cost. Oh, this cost, and that'll add a handle, that'll add a light, that'll add something. Oh, this looks beautiful, and there's the cost, and sell it. You don't sell it. So it's really turning a lot of thinking on its head. Design to life cycle cost is doing this, but over life cycle, saying, look, we're not talking about 1 year. We're talking about a factory for 10 years, a machine that's going to deliver. We're designing it to life cycle cost, also with design of what you're selling to cost. And if you like services, do we over provide services? And I think we do. A lot of us would just like the service, clearly specified and delivered, but not the add-ons and whatever else. And target costing is, again, since designed to cost, trying to hit a target. So focused, customer focused, product service focused costing, really. Reporting can help with budgeting and cost reduction. Reports for actions should have the purpose of the report, the content, deliverables, and feedback. Selecting key performance indicators, and I like the term, indicators to me are, indicators, a dangerous word because it's a light flashing, maybe orange, red, green, whatever, fine. Oh yeah, it's flashing red, carry on. I would rather use the word deliverables. This is what is to deliver. And again, using KPIs or KPDs almost indicates, I would say the culture should be clear that it's deliverables we're looking for. We've got indicators, but you're to do something. In other words, it's more than the indicator, light flashing, it's delivering. So culture is so important that people like that, are happy with this. And I'll absolutely accept that if I'm sounding like a hard-nosed engineer or something, then okay, so be it, and a hard-nosed accountant. There are cultures for sectors that are different. It's not a uniform culture by any means. Different people like different cultures. Different people do their best in different cultures, in fact. Cost awareness. Have a cost aware culture. Simply be and make everyone cost aware. Employ consultants to affect change. Well, if you've got the money, yes. Carry out cost awareness exercises by surveys, suggestion schemes. Constantly measure and report relevant costs. So we're back to key performance deliverables. But the cost awareness culture is good. Some companies are better at that. The culture would be that we don't spend money unless we have to, but it can become mean. What I'm saying, these slides, cost budgeting, cost awareness, cost reduction, all the strong element of the culture there. And that's important for people running businesses, selling businesses, mature businesses, financial advisors to businesses. I'm sure you do. Check out the culture first. And if you want improvement, it may be simply not a dramatic change in culture, but slight change. This is where I suppose CEOs are paid their squillions, because some are really worth it because they bring a culture and a change, not just in the operating methods and selling off branches and things, but and growing sales, which is all good, but they actually also bring the culture from the top. And again, I think we're all aware of that. We see poor culture and we see good culture, so important. Another technique that comes back every so often, the Treasury will be dusting down their books on this. They've had books on this for 50 years or more, and it pops up every so often. Zero-based budgeting is simply, why is a cost incurred? Why do we have to do something? Is it incurring the cost necessary, which is a slightly different question. What levels of effort are required? So we're going to acknowledge that some cost must be incurred, but actually how much do we need to do, and how can resources, therefore, in a sense, how can resources best be used? So zero-based budgeting, to me, forever with us, and probably in an informal way, but sometimes an exercise is worthwhile. Over the years, again, used to zero-based budgeting exercises, and they work. They often need revisited. A decision analysis package. So here you have some management stuff. You, in quite a lot of detail, you have an activity. So you break down your budget areas into right down to the details of an activity, um, and responsible person, a ranking will be put in, reviewer reviews paper. The objectives are to have paper available to print. I'm thinking of maybe the stationery cover. Outline description, a cupboard at the end of the corridor, alternatives, outsource, projected costs and revenue. There's no revenues, it's only cost. Performance measure, how often are we out of paper? What does it cost us? Effective non-approval of stationery disaster. Benefits, we'll keep going. So I'm making it very trashy and simple, but even for that level, you can get something, because I think what you're going to find is cheaper supplier, which you should have thought of, steeper supplier. Anyway, you could get a supplier who stocks your stationery cupboard. Again, we're back to supply chain. So many things interrelate. No rocket science, but just they come together. And and then how about the culture side? As I know one company who's still, well, there's someone in charge of the stationery cupboard, and the stationery cupboard controller, Dragon, has the key, and they will not let you have a new pencil unless your pencil is no shorter than an inch. I mean, no joking. And it's done as a joke, actually, in the company, but there's control. So what's said BB about? It's petty. No, it's not. At the bigger scale, it's very important. What you then do is actually rank activities, and the view there is you bring it together that there will be ranking which is essential, which goes through. There'll be ranking to a level. You then start allocating your scarce resource, which at the end of the day is cost, which are cash available to spend. You rank them and hopefully come out with a viable business, but with the lowest sensible cost. Of course, WB can go mad like anything. And that's costing. Checking the time. Yeah, we're going to have another break now. So let's get back for 25 past. 25 past. We're on time. I'm not sure. I mentioned the times where we are. I promised at the beginning. I hope you've not missed anything, and you're not going to. Cash flow models, project appraisal, but more about sensitivity analysis, and then a very brief sum up on governance slides. So just 2 or 3 I want to look at. I will now check any other questions that are in, but let's have a break till 25 past. Thank you. Welcome back. Just checking the time. Bang on. Right. I wanted briefly to touch on project appraisal just because it's my favorite subject, and that's not the reason. It is another issue for all companies, maybe less so mature companies, but even then, they have a future, mature, but a future. And the reason for looking at it here, though, particularly is not to go into detail of project appraisal, but there are issues on cash flow modeling. And it, to me, seemed a good way of pointing out sensitivity analysis. What is project appraisal? It considers the value of money over time. So, spending a lot of money today for an efficient rail system is worthwhile. The problem is you need to spend an awful lot of money. So buy cheap and repair ever more, as Henry Ford suggested would happen. It's just a very important area, and you consider the time value of money. Beauty of it is you can carry out sensitivity analysis on sales and income. You don't need to bring in the time value of money. I mean, a normal budget sensitivity analysis is maybe over a year, but you can play around with what if we have 5% decline in sales over the next few months. And you can express that as a percentage and it gives you indication that you should be doing something. It's a sensitivity analysis. It's an important part to me, and it can identify problems and opportunities. I mean, like, as always, there's always this tendency to look at, oh dear, what if, whatever. It might be an opportunity we haven't seen. And long-term effects of inflation can be considered. Again, that is a pure, true project appraisal issue. So sensitivity analysis, this is jumping from that to just make the point that it's so important if your accounts are audited, and let's hope your companies grow. I mean, I've over the years had companies that have grown from no audit, private companies, to audited companies. It happens. It's for a lot of you out there. I hope the people you're dealing with are growing, and I wouldn't wish an audit on them, but the life is that they'll have to have an audit. But going concern, there is actually a standard on this, and there was a question on going concern for charities. It might well be worth looking at this document if you're involved in charities or any business. It's, if you go to the Financial Reporting Council FRC website, current ISA international statements on auditing, number 570 is available there to download as PDF if you like, and you'll get a feel for the regulator's view of things. In performing risk assessment procedures, the auditor shall obtain an understanding of the following matters. Now, the whole thing about auditing today is it's rules-based. They can say what they like. Requirements. If you don't do a requirement, you're out. So maybe it's made for AI. A lot of us think it, I absolutely think it takes away, they push us to a professional judgment of thinking, be skeptical, do that. But this idea of ticking boxes, as a lot say, is to me potentially dangerous. Anyway, there are standards and there's a lot in them that's good, that has to be followed. Going concern is one, and you might like to have a look at it if it's something you come across in reviewing accounts. I know you come from lots of different backgrounds, activities. It would be well worth reading for a lot of you, I think. But at the end there, we auditors are meant to look into going concern and risk assessments, etc. And we are meant, in bold, to see whether the calculations are applied in accordance with the method and are mathematically accurate. So we're actually checking your sums, because it's companies that should do the risk assessment for going concern, and we should check them. So it is an audit requirement. So sensitivity analysis, risk assessment, very important. Right. What level of sensitivity? I'm looking at a way for a project appraisal, but also for going concern. The idea would be what variation from zero NPV would be zero profit, if you like, in ordinary yearly cash flow. For a project, it's zero net present value for 40 years or something. Anyway, what would be tolerated? And I'm only suggesting these. I would think of increasing costs before NPV, 100% changes are doubling. Is that tolerable? I would think, yes, that's tolerable. We have not a problem here because costs have maybe got 10, 15%. 100% adverse change, tolerably, in other words, tolerable, presumably no problem, in the range 50 to 100%. So for costs going up by 50%, you would be asking the question, how material is the parameter? What can be done to ensure that 50% adverse change never occurs? It's actually, that's useful even in that range. 50% to 20%, tolerable if managed. Any parameter fell in that range must be reviewed and action taken. If you follow this, you're going to probably turn projects down. We come down to 20% or less adverse change not tolerable. Now, you'd have to have very good compensating or a guaranteed contract for cost, guaranteed income for 20 years. If you're not going to take note of that, or if you do take note of that, you're going to say, you're not turning the project down. Well, how do we tie down these parameters? And these are big figures for a project long term. The tolerances would probably be a lot less for a year's cash flow forecast for the next year. But, anything over, these days, I'd say anything over a 5% change in the year is intolerable, unless I can control it. That's really what I'm trying to get at, that this presenting sensitivity analysis in this way is saying to you, look, can you control this? Are you happy with it? Culture, you could get people to sign off on it. I mean, that's not cruel culture or anything else, but sign off in the sense that they, as the engineer and the marketing person, salesperson, are happy with it. You're not going to sack them, but they're experts. Take responsibility. Yeah, I'm back to being a Rottweiler. I must be nice. I'll be nicer in the next slide, right? Sensitivity due to inflation or deflation is a particular problem for projects today. And a very good example would be energy projects. Who knows? It's not the general inflation, it's specific inflation. And that's the issue. Too often it's just talked about general inflation. No, for a lot of projects, anything to do with energy, the wind turbines, the gas turbines, other fuel. And I would suggest coal. There's plenty of it in Britain, but of course that is not appropriate at all. But inflation or deflation, it's actually differential inflation that you're concerned about. This is not in your annual cash flow. No. One advantage of a structure of a spreadsheet, it permits the integrity to be tested. Very good way of testing it is to build a spreadsheet that allows for adjustment for inflation. And I'm not teaching this just now, and there's a formula 1 plus RR, 1 plus RF minus 1, explain what they are. If you're interested in this, look back. I'm coming to a slide which I hope will just clear the point, make clear the point I'm making. Pretty small print. And with my eye, I've got a problem reading it. But what will we look at? This is a project for a district heating system. So a bit more background. And if we look at the third and fourth rows across, we forget the discount factor. That's the adjusting the time value of money because it's over 4 years. These are 8 half-year periods. So over 4 years, the value of money falls, and income will fall in economic terms. We're going to get the net present figures. So don't worry about that. It's easy to say. The discount factor is what we use. Let's look at what we have. We have maintenance costs. We have labor cost period, and we've got labor costs and heat sales and electricity sales, net cash flows, discounted cash flows. And the big figure you can see, 139,202. This is a positive project. And what this would be is what they'd call district heating. You've got a block of flats. In fact, my son, they're in a flat with Sense district heating. So it's absolutely crazy to happen. Never mind. The heat water essentially pump it around at 70 degrees, have heat exchangers, reduce it to 50 or whatever degrees. Nuts. But that was seen by the architect as good at the time. So you've got capital costs of the equipment in the first year, the 817 and 475. You've got maintenance costs over the year. You've got labor costs and heat sales and electricity sales. And you come to a wonderful net present value. It's got to be positive of 139,202. So it's worthwhile installing this equipment. And what we're doing is we're showing that the project's annual rate required is 5% because it's a low interest rate. It's for a community project, etc. We're then putting in inflation annual rate of 10%, so we get a combined rate of 15.5, and the project works. I realize I'm not allowed enough time, and I should have 20 other slides and bore you to death. But what I'm saying is project appraisal lets you look at time value of money and inflation, if you like. And there it is as a project with maintenance costs over time. Purely, this one has the 15.5% annual rate and inflation on everything at 10%. So key things in this slide now are, we still have the project presented in other ways with 139,202. It's a viable, valuable project. If you look at the annual increase in all costs was 10%. The rate we reduce the discount is a mix of the required 5 and the 10 inflation, which turns out to 15.5 is the way the arithmetic works. The project is viable. So you either do it at a 5% rate and it's viable, or you do it at 15.5% rate with 10% inflation. And this proves the integrity of the spreadsheet. That's what I'm really doing. So, simple terms, this is a viable district heating project. But what if inflation is not regular? There's differential inflation. I have at the bottom 8% on costs, so that's less than the annual. That's great. We're keeping maintenance costs down. Ooh, labor costs 14%, which could be very real today, more than your average increase. The heat sales are only 2%. Why? Because to get people to buy into this project, you guaranteed hot water for 4 years with only maximum 2% increase. And electricity sales go up a little bit, but the project is dead, minus 66,866. This is maybe the most valuable thing with longer term project appraisals, where you have distinctly different income and cost streams, which are likely to have different differential rates of inflation. And it has to be said, governments generally globally do real rate analysis, which was the first one I put up. They ignore inflation because economists tell us you can. To me, it's always been a nonsense, but there we are. So enough maybe of this. Have a look at them. If people are really desperate, I can send you the spreadsheets. I'll email them to you, and you can have many happy hours looking at the spreadsheets, and we're playing around with them. But they're in other books I've written, but I wouldn't. The one is out of print, I think, fortunately for you, and the other is an outrageous price, and it's you can do this stuff yourself. So project appraisal. No, cash flow sensitivity analysis, whether for long-term projects, and I've just enough on that topic, but I would do the same sort of exercise in arithmetic to come up with what are the maximum ranges of cost increase, income falling I will get with my project, and are these therefore tolerable or not? If they're intolerable, then we need to tie them down or give up, hopefully not give up. And you can do that same exercise on a present value method. I should have deleted these slides. This is just things I like. You could look at it as an annualize all the amounts, and you get the same answer. That's the point. It proves your spreadsheets. Right. The need for a consistent, robust process is really what it should be saying. Project appraisal, an integrated approach. Set a required rate, criteria, and appraisal measures. Screen your proposals from a business objectives point of view. Don't rush in and do things. I mean, does it really fit in with your business? Ask for screening appraisals, which means a rough appraisal. These ones I was showing you, you would call screening appraisals, just rough. If things still look okay, they are detailed appraisals. Have a very clear review process. And what people never do, if they're repeating projects, it's true of the biggest companies out. It would make a great deal of sense to do a post-investment review of every project to see how it turned out. You probably wouldn't need to do much work because most hopefully would be successful, forget it. But what you're looking for is the ones that went wrong and why they went wrong. What you're looking for is any flaw in the appraisal process and the arithmetic and work done earlier. So that's what I'd have as a standard appraisal process, and hopefully, I'm sure most good companies, governments follow it. Summary. Methods to improve the accuracy of your forecasting. So this really is going right back to where we started. How can we improve forecasting and therefore sleep at night, I suppose, and be more diligent in your research, your own or purchased research, or good old AI. Use true leading indicators, which I have to say are difficult to find. Some industries just don't have them. Others, airlines, hotels, etc., do have them. But get leading indicators and use them. They'll only lead so much further ahead. There are limits. Use extrapolations, updating and tempering data when possible. Extrapolations are there. The beauty is they're based on reality. It's still, where you might be going. But trend lines, watching them month by month. That restaurant I showed you should have shut down. I mean, I was saying I think we should shut down a year before it did. And more money would, not more money recovered, less money would have been plunged into it. Use models, but continually update the forecast model for amounts, time, and probabilities. That's something else. You can bring probabilities into modeling. I'm totally against it because, I mean, you've got subjectivity on subjectivity, but there are types of business situations where probabilities, then you would get the sensitivity to the probability of something changing. To me, it's a worry that you start being able to read it. But probabilities can help in some situations. Absolutely analyze sensitivity, guarantee amounts, well, if you can. I mean, that's not open to most of us. And mature or not, my last slide of the collection of slides, there's a whole lot more that follow. I want to just go to two of them, make a point on governance, because I realize I'm having to write things for clients, say, look, you need, not that you run a great business, but look, I need this sort of stuff, and they will draft something for me, I'll do together. We need better to demonstrate we're doing things properly. But anyway, to mature, whether you're mature or not, capital needs to be managed. Your spend, your income, and your activity. What I'm saying there is, it's the return on capital employed. Your spend costs and your spend on capital, fixed assets, etc. Your income, obviously, sales, and how active you are. I mean, that is the other thing that comes out of return on capital employed. If you can just do more, easier said than done. What if we don't do so much? Good margins, costs under control, but you're out of it. So a sort of slogan slide. Now, let me get the script for the slides. The reality is I'll just go through them all till I get there. Director's responsibility. I'll flick through them. I'm not even going to stop at some, but these bank of slides was about being a director today, as it were, responsibilities. You might like to look at them to see if there's anything, oh gosh, I never thought of that. So we'll go through structure, types of company, the Companies Act 2006, unlimited companies, private companies, memorandum, method of forming company requirements. This is all detail, and I realize you just don't need. There's the duty to promote the success of the company, which was in the notes in abbreviated form. So this is slide 95. This is what the Companies Act actually says. The director must act in accordance with the company's constitution and only exercise powers for the purposes for which they are conferred. And there is a duty to promote the success of the company. And we had the list there earlier on. Yeah, it's full of company law jargon. I'll skip that. I should have skipped it. There's a duty to exercise independent judgment, a duty to exercise reasonable care. And this is the problem again, is these are in the Companies Act. I'm not the lawyer, I'm not the regulator. Regulators and courts these days seem to make up rules, but this is company law. A director company has to exercise reasonable care. You get these words coming in. This may well be law for long. So that's what I really want to say. Beware of this acting in the best interest of the company. Your duties may be spelled out more. Duty to avoid conflicts of interest is always there. Not to accept benefits. I mean, a lot of this could be tightened up. But we have various other laws in place as well. Fiduciary duties, Bribery Act, etc., employment law. We're well aware of, I think, all the laws. Who is a director is usually clear. I love the idea of shadow directors. I've known a few in my time. Once we had accounts to be signed, I said, I've never met this director. Where is he? And the sort of cupboard door opened and out he came. It was another room. He went back into the room. So that was a shadow director. We don't want any of them, really. De facto directors, that's an interesting one that in a sense you can say, oh, I'm not a director, but in fact you are. Alternate associates. You've got to be careful of that. If you're an alternate director, you're still a director. That's something people sometimes miss. That, oh, you're an alternate, should something die, you step in, but you are then immediately a director. You can't say you're not. Very important for audit. You're going to hear more if you don't, and it's only going to get tighter. The FRC wanted to tighten up the auditing standard, but I and better people than me said, this is ridiculous. Related party disclosures. And it covers family, people, friends. The problem with tightening it up is there's no end to it. I mean, my view is, and it is a worry, I think in some ways, the auditing I see it from, but I think other ways, we are starting to police companies, and that's the job. I think it should be a state job. I don't, it's an interesting area. So I'm getting on interesting ground here. Move on, Ralph. Related parties always have been important. The company law require them, but never that was never seen as important as the auditing standards. So you will be asked about friends and family, suppliers that you're friendly with, etc. The basis of corporate governance, risk collectors face lots, disqualification, employee benefit trust. That's the thing that seemed to be quite popular. And as I say, one client's moved to this interesting area. Ownerships, what is a PLC? Corporate governance is always under review. There's a governance code. Do look at this. You could talk of this as much as I could. Innovation of the board, directors' competencies. This is a very important. This was the other. I think I've covered one side of the related parties. The other one that appears in auditing standards is judgments, estimates, and assumptions. A recurring theme of the corporate reporting review has been the IFRS requirements for disclosure, and UK accounting standards, well, are not met. You have to be very clear why you've judged to do something, why you've judged to depreciate an asset over 4 years, why you've got an estimate or a provision for a legal case that seems low, and why you've made assumptions. What is the basis for assumptions? So a lot of tough stuff there we auditors are aware of, and apparently we've really got to question you on more. Directors' ethics. Ethics are all the rage. Again, I'm afraid a grey area in that one professional body says the standard of ethics is what the public expect. Ethics, what the public. And so my retort was, well, I don't watch Dublin, but I said I've seen enough to say if that's the standard of public view, then I'm worried. But ethics are important. It amuses me we have to take tests in ethics these days. Professional people do, a lot of you will. The one person who will always pass an ethics test, what multiple choice is, the unethical person. If they don't, they're not very good at being unethical, are they? No. Ethics, serious matter. How you teach it, how you test it, difficult, I'd have thought. Director motivation, role of the board, blah, blah. And I'm really skipping through. I think I touched on the two that I wanted to about NEDs. You might like to look at these slides. It might be off just something there would be good to you. And it got there rather quickly. There we go. The very last slide. Do look at maybe the directors ones. There might be something of use. To me, the important thing to say today was about being a mature any company is related party disclosures and judgments and estimates. Hopefully not issues. You're clear on what your responsibilities are. Where do you want to be? Identifying strengths and weaknesses, priorities, identified at appraisals, crafting personal development plan. Yes. So that is there. Now, there was one question I haven't answered. That was a very good question on where do we get models, if you like, of working capital profiles, good, bad, and whatever else. And the answer is, I'm going to say, I don't know now. Years ago, I think everything was more coherent and similar, that there were published annual views of working capital for a cotton producing industry, for machining, for retail, for this, that, and the other. The varied way of the world today, it's just, it would be that you could do it, but the outcome would be so averaged and so unuseful that it's not worth doing. What I have to do, and I'm sure you do, is get my competitors, suppliers, companies, whatever I'm looking at, look at large and small. And it doesn't take you long. You could, again, set up a spreadsheet with the arithmetic simple, just plug in the figures and get an idea of whether whether you're worried about your own company or concerned, then see whether you fit in. I mean, this is the sort of thing I do for audit. We have to do a preliminary review. Is some interesting business that they do, even though they're interesting and big, they'll have similarities here or overseas, Australia, America, other countries, same sort of size. You look and see if their ratios of working capital, return, etc., are in line. Often they're not, and then you've got to rationalize, is the reason. You don't just decide because of this, that, or the other, but does this tie in with what you know? Yeah, they have different income streams, so that weights the amount of cash or creditors they carry, etc. So I don't think it's difficult to do yourself, but I'm afraid I think you have to. So on that point or that note, I will cease. I will stop sharing and see if there's any more questions. Yeah. I will cease talking there. Anyone who wants to get in touch can track me down somehow. Search the web. I'm sadly there. Thank you very much for listening.